Anytime you step into the financial markets, you're faced with a choice. And here's the thing, a lot of people don't even realize they're making it. The question is simple. Are you an investor or are you a speculator?
So, let's get right to it. What is the stock market to you? Is it basically a giant casino? A place to lay down some quick bets and hope for the best? Or do you see it as a way to buy a piece of a real, living, breathing business? Seriously, how you answer that question pretty much sets the course for your entire financial life.
So, to really dig into this, we're not just going to pull ideas out of thin air. Nope. We're going straight to the source, to the masters themselves, Benjamin Graham and David Dodd. Their book, Security Analysis, isn't just a book. It's basically the Bible of value investing. And get this, it was first published way back in 1934, right in the thick of the Great Depression. The crazy part? The ideas in it are just as rock-solid and relevant today as they were back then. It's a truly time-tested guide.
Okay, so what we're really talking about here are two completely different ways of thinking. It's like two different worlds. On one side, you've got the speculator. They're totally obsessed with one thing, price. Their only question is this thing going to go up tomorrow? The famous investor Seth Klarman nailed it when he said they just see stocks as pieces of paper to be quickly traded. But then you have the investor. They're focused on something else entirely, value. They're asking, what is this business actually worth? Because for them, a stock isn't just a piece of paper. It's a real slice of ownership in a real company.
All right, if the investing path sounds so logical and, sensible, then why isn't everyone doing it? Good question, right? Well, it's because the other path, the path of speculation, has this incredible pull. It's seductive. It's like a siren call. Let's talk about why it's so hard to resist.
At its heart, speculation really runs on one fuel, hope. It's the simple hope that somebody else, the greater fool, as they say, will come along tomorrow and pay you more for that little piece of paper you bought today. It doesn't matter if the company is doing well or not. It's a pure guessing game about mob psychology, not a careful analysis of a business. And this is where it gets really, really dangerous. Because, look, when the market is just going up, up, up in a big bull market, even the craziest speculation can look brilliant. You make money, it feels easy, and suddenly every gambler starts to think they're a financial genius. This quote from Seth Klarman just sums it up perfectly. And that kind of environment makes it unbelievably tough for a disciplined investor to stay the course.
Okay, so let's step away from all that noise, from the madness of the crowd. Let's pivot and look at the core, the foundational rule that a true investor lives by.
This right here, this is the whole game. It's a total mental shift. You have to stop thinking you're buying a ticker symbol that wiggles around on a screen. You're buying a fractional piece of an actual business. Seth Klarman put it best, you should analyze that tiny slice as if you were about to buy the entire company. That simple idea completely changes everything. It anchors you in the real world of business, not the fantasy world of the market. And here it is, the definition straight from the horse's mouth, from Graham and Dodd themselves. Let's really pull this apart. Thorough analysis. That means you actually have to do the work, right? Do your homework. A satisfactory return? Sure, that's the goal. But listen to this next part, because it's the absolute key. Promises safety of principle. Think about that. An investor's number one job isn't to get rich quick. It's to not lose the money they started with. Anything that doesn't meet that standard? Well, according to Graham and Dodd, that's just speculation. Period.
Okay, so safety of principle sounds great, but how do you actually do that? How do you protect your money? Well, Graham and Dodd didn't just leave us hanging. They gave us one powerful central concept that everything else is built on. It's the bedrock of their entire philosophy.
And that concept is the margin of safety. This is it. This is the investor's ultimate defense. So you've done all that hard work, that thorough analysis, and you've figured out what you think a business is really worth. The next step is crucial. You have to insist on buying it for a lot less than that. That discount, that buffer between the real value and the price you pay, that is your margin of safety.
If you want to boil it all down to a simple image, here it is. Value investing is all about one thing: buying a dollar bill for 50 cents. It sounds almost childishly simple, doesn't it? But trust me, that idea is incredibly profound. So what's this buffer really for? What does it protect you against? Well, think of it as your shield against a world you can't predict. It gives you room for error because, let's be honest, your analysis will never be perfect. It protects you from just plain bad luck. And maybe most importantly, it insulates you from the crazy emotional mood swings of the stock market. It's not about being aggressive, it's about being defensive.
And here's what's so wild, and Warren Buffett, Graham's most famous student, points it out here. The idea of buying a dollar for 40 cents is so obviously a good deal, right? It's pure common sense. And yet, almost everyone in the market just ignores it. They get completely swept away by greed, by fear, by the thrill of the chase.
Now you might be thinking, okay, this is all well and good for the 1930s, but we're talking about a concept that's almost 100 years old. How on earth can it still matter in our world of algorithms, high-frequency trading, and 24/7 news? It's a fair question.
And the answer is simple. Markets change, technology definitely changes, but one thing doesn't: human nature. The game is still run by the same two emotions it always has been: greed and fear. Margin of safety was never about timing the market or having the fastest computer. It's a defense mechanism against the timeless, unchanging flaws of human psychology.
I mean, this quote from the original book just says it all, doesn't it? The financial world gets completely obsessed with the superficial and the temporary, the headline of the day, the hot new trend. Graham and Dodd's entire framework is basically the antidote to that. It forces you to ignore all that noise and focus on one thing: real, durable, long-term value.
So, all of this brings us right back to where we started. The principles are out there. They're not a secret. Anyone can learn them. But, and this is a big but, actually using them requires a very specific kind of mindset, a certain temperament.
Listen to the greatest investors, and they'll all tell you the same thing. Success in this game isn't about having a 200 IQ. It's all about temperament. So you have to ask yourself, do you have the patience to just sit and wait, maybe for years, for the right price? Do you have the discipline to stick to your guns when everyone around you is getting rich quick on some crazy bet? And maybe most importantly, do you just hate the idea of losing money?
You know, here's a really fascinating idea that Buffett and others have talked about. You can't really decide to become a value investor. It's almost like you're wired for it or you're not. When you first hear that idea of margin of safety, it either clicks with you on a gut level or it just sounds like a foreign language. It's almost more a personality trait than a skill you learn in a classroom. So, we'll leave you with this one last question to think about. Next time the market is going crazy, when the headlines are screaming and prices are either rocketing up or crashing down, just pause for a second and ask yourself, who's in charge right now? Who's answering the call? Is it your inner investor, the disciplined business owner looking for real value? Or is it your inner speculator, the gambler just looking for a quick thrill? Ultimately, that choice is always yours.